Hello and welcome to Understanding Trusts. So we'll start off with what is a trust. A trust is a vehicle used to hold assets or run a business for the benefit of listed or potential beneficiaries. It's not recognised as a separate legal entity, and that's why it requires a trustee. The rules of the trust are set out in the trust deed, and typically a trust can exist for up to 80 years. Key people or positions. We've got the appointer, and that's the person that has the power to remove and appoint the trustee, and generally the appointer is considered to have control of the trust. Beneficiaries, these are people or entities that can be made entitled to distributions from the trust. Generally they're split into three groups. Primary beneficiaries, the people that secondary and tertiary relationships are drawn from, and usually this is the husband and wife in a business relationship. Secondary beneficiaries are the family members of the primary beneficiaries and any directly related entities, for example a company that a primary beneficiary might be a director of. And tertiary beneficiaries are the extended family members and generally a large list of included charitable institutions. We also have the settlor. For a trust to be created, it must have trust property. The settlor provides an amount of money, for example $10, in order to establish the trust. The settlor should be an unrelated party who you don't plan to have contact with again, as the settlor can never be or become a beneficiary of the trust. And finally, the trustee. The trustee is responsible for the trust. It holds the assets of the trust as trustee, makes decisions about trust operations and distributions of income. The trustee can be either an individual, group of individuals, or a company. So how important is the trustee? And the answer is very important. The trust deed contains all the rules for the trust, including the definition of income, the powers of the trustee, and what happens if a trustee dies. If a trust deed doesn't allow a transaction to occur, despite the law at the time, the trustee cannot facilitate the transaction. For example, if your trust deed doesn't say that you can invest in shares, and that's a viable investment and activity for the trust, even though at general law trusts can invest in shares, your trust wouldn't be able to do that without a deed upgrade. So when was your last deed reviewed or updated? There are quite a few different types of trusts, so we'll just go through the common ones now. We've got a unit trust. So this is very similar to a company where units are issued. Depending on the trust deed, units can be categorised as income units or capital units, and that would restrict the types of distributions that those units would attract. Income is distributed based on the unit holding, so it isn't flexible. It is a useful structure if you're looking at unrelated parties in a business together. And should a unit holder become bankrupt, their units are treated as personal assets and may be sold to raise funds to pay creditors. So that's something to keep in mind. The other common type of trust is a discretionary trust, and this is probably the most common, and we will probably focus mostly on this type of trust for the rest of the webinar. Generally, they're used to hold family assets and are often termed family trusts. No beneficiary has any entitlement to income, so it must be distributed at the discretion of the trustee. Discretionary trusts offer greater asset protection than unit trusts, where units are considered assets, and assets can be transferred from generation to generation through the use of discretionary trusts. So who should be the trustee? An individual or a corporate? If it's an individual, you must ensure that all assets are documented as held on trust so that they are protected from personal creditors. As the trustee, you are responsible for the trust meeting all its obligations, and you could have legal action taken against you, putting your personal wealth at risk. If there is a change in trustee for any reason, for example death, all asset holdings, for example shares and real estate, would need to be updated to reflect the new trustee. If it's not properly documented the first time, Stamp Duty's officers may see it as a change in ownership and assess duty on that change. If you have a company as trustee, You still need to ensure that all assets are held on trust, but it's easier to change control, as this would generally be a change in the director of the corporate trustee. For example, if the director of the trustee died, the legal personal representative could become director and make decisions regarding the trust property until a permanent director is found. And you should talk to a solicitor about your will and check the company constitution. A corporate trustee also provides an extra layer of asset protection, as if the trust is sued, generally the company has limited assets, usually about $2 of share capital that creditors can access. And furthermore, the company directors can only be held liable if they have breached directors' duties. So some advantages to having a trust is that it just creates some flexibility to distribute income to a number of people and have it taxed at marginal rates. You can also facilitate tax being capped at 30% by distributing excess profits to a company. However, if this is done, monies must either be paid across to the company or a loan agreement entered into. This is quite a recent ATO measure, so it's something to keep in mind and make sure you seek advice about. It also provides asset protection, as wealth is separated from the individual who could be at risk of a lawsuit. It provides a mean to transfer wealth across generations. You can still gain access to the 50% 12-month capital gains tax concessions on sale of assets, and asset protection, particularly with a corporate trustee, to a certain degree. Assets of the trust are protected from personal creditors, and personal assets are protected from trust creditors. Some disadvantages, though, is that you must ensure that the documents are established and executed correctly. You cannot distribute losses to beneficiaries. It's difficult to transfer losses to other trusts. There's no perpetual existence. Normally, a trust must be wound up within 80 years. You may be required to make a family trust election, which can limit some flexibility of beneficiaries. And generally, the ATO doesn't like trusts and is continuously targeting, hence the new requirements on distributions to companies. So how do they work? So the trust generally runs the family business or holds the family wealth assets. It is the trust's ABN that is used for GST purposes, as it is the business entity. At the end of the year, the profit and loss is calculated, and the trustee must exercise its discretion if it's a discretionary trust and declare a distribution of income at the end of the financial year. This requires good documentation via minute. Income is distributed in the trust tax return, and tax is paid at the beneficiary's marginal tax rate, generally by that beneficiary. The tax rate's flexible and varying. The distributions owing are reduced by any drawings taken during the year or in prior periods where drawings exceeded the declared distribution. Income distributed retains its character in the beneficiary's hands. For example, capital gains remain capital gains, foreign income remains foreign income, and if the deed permits, you can stream certain types of income, but there are rules around this, so again, seek some specialist advice. Just a couple of case studies. The first one, we look at John and Sue. So John runs his business through a family trust, and the business taxable profit for the year was $107,000. Sue works full-time and receives a salary of $50,000, and they have 2 children who are in primary school. So we'll just compare the tax savings through running a business through the trust compared to John operating as a sole trader. So as a sole trader, John would have paid just over $29,000 on his $107,000 profit, and Sue would have paid just over $8,500, so their total tax would have been $37,704. If he used a trust, though, John would have some flexibility on the distribution of that $107,000. So we could go the first $80,000 to John, the next $30,000 to Sue, and any remaining amount to John and Sue in equal shares, and that would form part of the trust minute. Once we do that, we'd end up with John having $80,000 of income, and Sue would have $77,000, which is the $50,000 of her salary and wages plus $27,000 from John's business. And we see total tax then comes to $36,500. There's a small tax saving there of $1,100. In prior years, if they had a trust with the 2 children, they could have distributed to the children, but in recent years, the tax office has reduced the amount that can actually be distributed to a child without it attracting large marginal tax rate. So that has decreased since about 2011, but there was still a saving overall of about $1,100. With case study 2, we've got Steve and Jane. So Steve works full-time for a wage of $80,000 and Jane works part-time for a wage of $30,000. They have a trust that they use to hold investments in shares and property. In the 2013 year, the trust had the following income. It received fully franked dividends of $4,000. So that $4,000 reattaches $1,700 of franking credits, which gives total dividend income of $5,714. And they also sold a property that they were holding in the trust for $400,000, and the property was purchased in 2008 for $320,000. So they've made $80,000 on that property. Jane has some carried forward capital losses of $35,000 from previously sold shares and managed funds. So we'll just compare the savings again through holding the investments in joint names or holding them in a trust. So if we held the investments jointly, they'd each get half of that total capital gain on that property sale, so $40,000 each. Jane would have $35,000 of her carried forward losses, so her net gains gets reduced down to $5,000. They then get a 50% discount because they've held the property for more than 12 months. So Steve would get $20,000 discount and Jane $2,500. So their actual taxable gain together would be $22,500. We then add on their salaries and their share of the dividends, and we'd end up with taxable income of $102,857 for Steve and $35,357 for Jane, and total tax after the franking credits of $29,583. However, if they used it in a trust, the trustee could decide to distribute all the income to Jane. So in that case, Jane would get the total capital gain of $80,000. She'd reduce that by her carried forward capital losses, and she'd get a net gain of $45,000. She'd then apply the 50% discount to get a taxable gain of $22,500. Then add on their salaries, all the dividends and franking credits go to Jane, and we end up with taxable income of Steve of $80,000 and taxable income of Jane of $35,714. So after tax and franking credits, their total tax payable is $20,876, or they've saved just under $9,000 through using a trust to hold that appreciating investment property. So you should have got a little handout that you can fill out and just familiarise yourself with your current business structure. So basically what we want you to do is just fill out the information that you know on the handout, and if you don't know anything, contact us or your advisor to go through the unknown information. Consider any risks that individuals or entities may expose to, and do you think your existing structure effectively protects assets from these risks? And then finally, if you'd like to discuss your current structure in depth and its suitability to your current situation, please contact our office, or if you have any other things that you'd like to discuss, you can always contact our office on 0741518898 or email mail@themoneyedge.com.au. Thank you for your time.